Welcome back. Most first-time buyers believe their lender will automatically cancel PMI once their home equity hits 80%. That's the wrong belief, and it's costing homeowners thousands of dollars every single year. Here's the reality. PMI removal on Chase mortgages requires a written or phone request from you, the borrower. No request, no removal. And according to HUD servicer policy data and RISPA disclosure requirements, borrowers who don't take action continue paying PMI indefinitely, sometimes for years past the 80% loan-to-value threshold. In the next 9 minutes, I'll break down exactly how this happens, show you real case studies, and give you the exact steps to reclaim your money. Let's start with the numbers. PMI, or private mortgage insurance, typically costs between 0.5% and 1.5% of your original loan amount annually. On a $300,000 mortgage, that's $1,500 to $4,500 per year. Over 10 years, you could easily pay $15,000 to $45,000 in PMI alone. Now, imagine paying that for 15 years because you didn't know you had to request removal. That's the $34,000 figure we're talking about. And Chase, one of the largest mortgage servicers in America, isn't going to remind you to make that request. Here's the critical part that most closing disclosures fail to highlight. The Truth in Lending Act and RISPA require lenders to provide you with information about PMI cancellation rights. But providing information and actively helping you are two very different things. Chase is required to tell you about the 80% LTV rule in your closing documents, and they do. But they're not required to monitor your equity and notify you when you've hit that threshold. That responsibility falls entirely on you. Let me walk you through a real case study. Meet Sarah and Tom, a couple who purchased a $400,000 home in 2018 with a 10% down payment. That's $40,000 down, leaving them with a $360,000 loan. Their PMI was $270 per month or $3,240 annually. Fast forward to 2022. Through a combination of mortgage payments and home appreciation, their home was now worth $480,000. By the bank's calculation, they had hit 80% LTV. Their loan-to-value ratio was now 75%, well below the 80% threshold. But Sarah and Tom never received a notification from Chase. Why? Because there's no federal requirement for Chase to send one. They continued paying $270 monthly for PMI for another 18 months, an additional $860 in wasted payments, until Sarah happened to mention the equity gain to a financial advisor who told her to call Chase and request removal. When she did, it took Chase 30 days to process the request, and the PMI was removed retroactively to the date of the phone call. Chase refunded 3 months of PMI, $810, but Sarah and Tom never recovered the remaining $4050. That's real money lost because they didn't know they had to ask. Now, some of you might be thinking, well, what about refinancing? That's another trap. During the 2021-2022 refinance boom, many borrowers thought refinancing would eliminate PMI. In some cases, it did, but only if they had built enough equity during the refinance to avoid it. If you're refinancing a $360,000 loan on a $400,000 home and rates haven't moved much, you're still taking out a new loan with PMI attached, plus you're resetting your 30-year clock and paying origination fees all over again. That's often more expensive than simply requesting PMI removal. Let's talk about the legal requirement here. The Homeowners Protection Act of 1998 established rules around PMI cancellation. At the 80% LTV milestone, borrowers have the right to request PMI removal. At 78% LTV, lenders are actually required to automatically remove PMI, but here's the catch. Many servicers, including Chase, interpret this rule conservatively. They use the original home purchase price to calculate LTV, not the current market value. So if you bought your home for $300,000 and it's now worth $400,000, Chase might still be using the $300,000 figure for their LTV calculation. You'll need to provide an appraisal to prove otherwise. And that appraisal costs $400, $600 out of your pocket. Here's another critical detail that most people miss. The type of loan matters. Conventional loans have different PMI removal rules than FHA loans. If you have an FHA loan through Chase, PMI removal is even more restricted. For FHA loans taken out after June 3, 2013, you're stuck with mortgage insurance for the life of the loan if you put down less than 10%. If you put down 10% or more, PMI can be removed after 11 years. That's a massive difference from conventional loans, and many borrowers aren't told this at closing. Let me give you another case study. Michael purchased a $250,000 condo in 2019 with an FHA loan and a 5% down payment. His monthly PMI was $186. In 2024, his home was worth $310,000 and he'd paid down his loan to $220,000. by any reasonable standard. He had more than enough equity to remove PMI. But because his loan was FHA, he was told he had to wait until 2030, 11 years after closing, before PMI could be removed. Michael's only option was to refinance into a conventional loan, which meant paying $3,500 in closing costs, but would save him $186 monthly going forward. He'd break even in about 19 months and save over $13,000 by the end of the original loan term. Unfortunately, many borrowers in Michael's situation don't know this option exists and simply accept the PMI for another 6 years. So what's the actual process for removing PMI on a Chase mortgage? First, you need to verify that you meet the equity threshold. Check your loan balance. You can do this through Chase's online portal or by calling their servicer line at 1-800-955-9060. Calculate your current home value. You can use Zillow, Redfin, or a professional appraisal. Divide your loan balance by your home value. If that number is 80% or less, you're eligible to request removal. Next, contact Chase directly. You can do this by phone or submit a written request. Many borrowers prefer written requests because you'll have documentation. Send your request via certified mail to Chase's PMI department. Include your loan number, the current property value, and evidence supporting that valuation. Chase has 45 days to respond, though they often respond faster. But here's where many borrowers get stuck. Chase will often request an appraisal. If your home value is borderline or if there's been significant appreciation, they might not accept a Zillow estimate. That appraisal costs $400, $600, and it comes out of your pocket. For some borrowers, especially if you're right at the 80% threshold, that appraisal cost might take several months of PMI savings to recoup. However, if you're significantly below 80% LTV, that appraisal pays for itself quickly. Let's do the math on a real scenario. Say you owe $240,000 on a home you bought for $300,000 5 years ago. That home is now worth $360,000. Your LTV is 67%, well below the 80% threshold. Chase requests an appraisal, which costs $500. Your current PMI is $200 monthly. You'll save $200 every month going forward. The appraisal pays for itself in just 5 months, and over the remaining 25 years of your mortgage, you'll save $60,000. That appraisal is absolutely worth it. Now, what about the counter-argument? Some might say, well, Chase offers good rates, so I don't mind paying PMI. That's false economy. PMI isn't a rate, it's an insurance policy that benefits the bank, not you. The rates Chase offers might be competitive, but PMI is a separate cost on top of those rates. You're not getting anything in return for that PMI payment. It's purely a risk mitigation tool for the lender. Once your equity is sufficient, you're throwing away money every single month. Finally, let me address one more misconception. I'll just wait until I have 20% down to buy. That's a valid long-term strategy, but for people who've already purchased and are paying PMI, waiting is costing you money. If you bought with 10% down and your home has appreciated, you might already qualify for PMI removal. Don't wait, check your status today. The bottom line, Chase won't remove your PMI automatically. You must be proactive. Check your LTV, request removal in writing, provide an appraisal if necessary, and follow up if you don't hear back within 45 days.